The S&P and the NASDAQ were both in the green today as Doug Flynn joins us, certified financial planner, co-founder, Flynn Zito Capital Management. Good to see Doug. And one of the headlines was this consumer confidence as well, where we saw an unexpected drop. So what did we see today, Doug? What did you make of it?
Yeah, it came in below expectations, and those expectations were already lower. Yeah. So that is unfortunate. And then you add that to the Case-Schiller home price index, which showed us a 6% rise in home values, which makes things less affordable. And so it's kind of weighing on people as it tends to do over time. And so now we're all looking to the Thursday data that's going to come out, which is always the key data. So that's why the market's kind of sideways, just digesting this sort of not great information today.
Well, as we wait for that, we do have great information because it's Tuesday, and that means it's Doug Flynn's Tax Tip Tuesday. And these segments are always interesting for, I think, viewers. You know, they learn a lot from them, quite frankly. So today, you're talking, I think, about when you're selling something, you're selling a stock, you're selling a bond, there's a few different ways you can go about it, right? So take it from there.
Yeah, exactly. And so the first thing you have to pay a lot of attention to is whether or not this is a short-term or a long-term hold of the investment. So short-term is 1 year or less if you bought it 1 year or less ago and then you sell it for a gain. Long-term gains kick in when it's longer than a year. And it's really important because there's significant tax differences. So paying attention to that is really important. And you need to know what you paid for it and what you sold it for. And then that all goes on your Form 1040 Schedule D, which some people are filling out now. But if you're selling now, it's going to be for next year. But once you do that, this is where it gets kind of interesting. There's really 4 methods that you can use to report what you sold. You can use what's called first in, first out, which is FIFO, last in, first out, specific share identification, and an average cost. So let me give you a quick example. If you bought Bitcoin at like 3 different prices, let's say you bought it at 20,000, you bought it at 60,000, and you bought it at 40,000. So you have these 3 specific things. And now it's at 57, and you want to sell some. If you just sell it, they're going to default to the first one you bought, which was the $20,000 price. You're going to have a very big gain. And so what you might do is go to the specific share identification bucket, which was that $60,000 bucket, and you need to tell your accountant and or put it on the tax return that you're specifically identifying those shares. Otherwise, the default is going to be probably not in your benefit.
But if you do that, a lot of people miss that. They probably do. But if you do that right, then you get the different cost basis, right?
You do. Then you, in that case, in that example, if you could sell the same thing you want to sell, but you're selling the $60,000 bucket for a tax loss today, but otherwise it might just report it as a huge gain off of the $20,000 or even the $40,000 price of the other buckets that you bought. So don't just sell it and take the report that you get from your broker or your mutual fund family and say, hey, here it is. Your accountant's just going to take that number, put on there. You need to know, hey, if some of these were bought high, I can identify and maybe pay less in taxes. And the real key is this: the difference in long-term gains, it's 0% for those that make below 47,000 as a single or 94,000 jointly, and it's only 15% up to $500,000. Where if it's short-term gains, that's ordinary income. So less than a year, the 22% tax bracket kicks in at 40-something thousand and 94,000 for married. So really important you pay attention to how long you hold it, and then identifying the buckets of whatever you're selling to get the most from it.
I don't think I oversold that at all. I think we actually did learn something again. As long as that's all legal, right, Doug? We're not breaking any laws or anything.
100% legal.
Oh, okay, 100% legal. Just making sure.
The only caveat is once you start with the particular method, you probably have to keep doing it. You can't kind of switch around at every turn.
No
That's
funny
the only
business. We don't want any funny business on the taxes. All right, Doug, thank you. Tax Tip Tuesday with Doug Flynn.